Hello everyone, welcome to the market opening bell on Friday, October 10th, 2025, your 10-minute guide to the stock market. Hong Kong stocks fluctuated with a softer bias. The Hang Seng Index opened 32 points higher but was dragged down by a decline in HSBC, falling as much as 348 points to 26,480 in early trading before recovering. In the afternoon, it briefly rose 148 points to a high of 26,978, but closed down 76 points or 0.3% at 26,752. The H-share index gained 6 points or 0.1% to 9,530, while the Hang Seng Tech Index fell 42 points or 0.7% to 6,471. Total market turnover was 386.8 billion Hong Kong dollars. Southbound Capital recorded a net inflow of 3.043 billion Hong Kong dollars into Hong Kong stocks. Notable floats included net buying Kuaishou at 1.086 billion, ZTE 457 million, Xiaomi 231 million, Shanghai Electric 106 million. Net selling include and SMIC at 2.396 billion, Hua Hong Semiconductor 1.141 billion, Alibaba 715 million, ending a 28-day net buying streak. Tencent 463 million, XTelPai 169 million, Sinopec 155 million. Data shows southbound funds have net bought Kuaishou for 3 consecutive days, totaling 2.079 billion Hong Kong dollars. Technically, without the drag from HSBC's decline, the HSI would likely have closed flat or slightly higher. Investors should observe for 1 or 2 more days to see if southbound capital inflows can push the HSI back above 27,000, with short-term support remaining at 26,500. On the first trading day after the National Day and Mid-Autumn Festival holidays, A-shares resumed with gains. The 3 major indexes rose 0.7% to 1.5%. The Shanghai Composite Index broke through 3,900, closing up 51 points or 1.3% at 3,933. The Shenzhen Component Index rose 199 points or 1.5% to 13,725, and the Chinex Index gained 23 points or 0.7% to 3,261. Combined turnover in Shanghai and Shenzhen reached 2.66 trillion yuan. The renminbi US dollar central parity rate was adjusted down 47 points to 7.1102. HSBC Holdings announced that its subsidiary, HSBC Asia Pacific, proposes to privatize Hang Seng Bank and delist it through a scheme of arrangement. If the plan is effective, scheme shares will be cancelled in exchange for a cash consideration of 155 Hong Kong dollars per share, representing a 30.3% premium over Hang Seng's closing price of $119 on October 8th. The offer values Hang Seng's entire issue share capital at approximately 290.3 billion Hong Kong dollars, with HSBC Asia Pacific paying a total of $106.156 billion in cash to scheme shareholders. The offer price implies a 2-to-5 price-to-book ratio of 1.8 times, significantly higher than comparable Hong Kong peers. Hang Seng Bank will retain its licensed bank status, independent corporate governance, brand identity, unique market positioning, and branch network. The privatization requires approval from Hang Seng shareholders, 75% or more of scheme shares in favor, with no more than 10% opposition, excluding HSBC's 62.14% stake, and Hong Kong High Court approval, with completion expected in mid-2026. The current price is about 3% below the privatization offer of $155, suggesting that selling in the market for cash may be more cost-effective. The privatization plan will impact HSBC CET1 capital adequacy ratio, which stood at 14.6% as of June 30, 2025. The deal is expected to reduce this ratio by approximately 125 basis points on the first day post-completion. The funds required for the privatization will be fully covered by HSBC's internal resources with no need for external financing. HSBC will maintain its 2025 target dividend payout ratio of 50% of earnings per ordinary share. Going forward, HSBC plans to restore its CET1 ratio to the target range of 14% to 14.5% through organic capital generation and by suspending further share buybacks for the next 3 quarters. Decisions to resume buybacks will depend on HSBC's quarterly review and internal approval processes. HSBC share price fell nearly 6% to 104 Hong Kong dollars, while Hang Seng Bank surged 25.9% to $149.8. Other local bank stocks, Dah Sing Banking Group and Bank of East Asia, rose 4.4% and 4.7% respectively. Chinese media reported that SMIC's A-share margin trading conversion rate was adjusted to zero. SMIC and Hua Hong Semiconductor shares fell 6.7% and 6.4% respectively. What is the margin trading conversion rate? Margin trading allows investors to borrow funds from brokers to buy stocks, known as margin buying, or borrow stocks to sell short. The conversion rate, also known as the collateral ratio or the margin ratio, indicates the proportion of a stock's market value that can be used as a collateral in a margin account. For example, a conversion rate of 0.7 means a stock worth $100 can cover $70 of margin. A conversion rate of 0 means the stock cannot be used as collateral, effectively freezing its role in margin accounts. This parameter is dynamically adjusted by exchanges based on a stock's risk profile to control leverage risk and prevent excessive speculation. Per rules implemented since 2016, a stock's conversion ratio is set to 0 if the static price to earnings ratio exceeds 300 times. SMIC's current static PE exceeds 300, often due to low earnings, rapid price increases, or inflated market valuations. The second rule is the static PE is negative, but this does not apply to SMIC. Impact on investors. First, existing margin positions. Stocks held in margin accounts can no longer be used as collateral. The system will recalculate the account's margin ratio, potentially leading to insufficient maintenance margin. If leverage is high, investors must add cash or other eligible securities within T plus 0 or T plus 1 or faced forced liquidation. Two, new margin positions. Investors can no longer use margin to buy SMIC or use it as collateral for short selling. New investors must use their own funds or cash equivalents. 3. Market impact. Some leveraged investors may be forced to sell, amplifying downward pressure on the stock price. Two new stocks will be listed today. Zhida Technology closed at $190.3 in Phillip Mart's gray market yesterday, up 184.4% or $123.38 from its IPO price. Excluding fees, a lot of 50 shares used a paper profit of $6,169. Golden Leaf International Group closed at $2.88 in the gray market, up 476% or $2.38 from its IPO price. Excluding fees, a lot of 5,000 shares used a paper profit of $11,900. U.S. stocks opened higher but closed lower. The Dow Jones Industrial Average fell as much as 330 points during the session, ending down 243 points or 0.5% at 46,358. The S&P 500 dropped 18 points or 0.3% to 6,735, while the Nasdaq slipped 18 points or 0.1% to 23,024. The Nasdaq Golden Dragon China Index, reflecting Chinese ADRs, fell 176 points or over 2% to 8,539. Large cap tech stocks show mixed performance. Nvidia bucked the trend, rising 1.8% to a record closing high of, of 192.5 US dollars. Oracle gained 3.1% and Amazon rose 1.1%. Tesla fell 0.7% and Apple declined 1.6%. Intel announced new products and manufacturing technologies as a core part of its business revitalization plan. The company states that its next generation Panther Lake processor, processor design is now in full production and will officially launch in laptops early next year. The chip uses Intel's 18A process technology, which the company claims offers advantages unmatched by competitors in the current market. Intel stock rose about 1%. PepsiCo reported a third quarter net profit decline of 11% year over year to 2.6 billion US dollars, with adjusted earnings per share of $2.29. Net sales grew 2.6% to 23.94 billion US dollars, slightly above market expectations. The stock rose 4.2%. Demand for the company's products was weak, with global food and beverage sales volumes down 1%, including a 4% drop in North America. PepsiCo noted that by aggressively cutting costs, accelerating innovation, and refining pricing and packaging strategies, it expects stronger growth and improved profitability in its North American business. The company maintained its full-year guidance, projecting core earnings per share to be roughly flat compared to last year, with organic revenue growth in the low single-digit percentage range. Delta Airlines reported a third quarter profit increase of 11% year over year to 1.42 billion US dollars. After adjusting for investment related items and other one-time factors, adjusted profit rose 15% to $1.12 billion. Adjusted earnings per share were $1.71, surpassing expectations of $1.53, while adjusted operating revenue grew 4% to 15.2 billion US dollars, exceeding forecasts of $15.06 billion. The stock rose 4.3%. Delta expects fourth quarter adjusted earnings per share to range between 1.6 and 1.9 dollars compared to market expectations of $1.65. The company projects operating revenue growth of up to 4% for the final 3 months of the year, above Wall Street's estimate of 1.7%. For the full year, Delta anticipates adjusted earnings per share of $6 at the higher end of its July forecast range of $5.25 to $6.25. Looking ahead to next year, Delta expects revenue growth, margin expansion, and improved profitability. Our stock pick today is Jenscare Scientific, stock code 9877. Jenscare Scientific primarily focuses on developing interventional products for treating structural heart diseases in China. In the first half of this year, the company made significant progress in its product pipelines for tricuspid aortic and mitral valve disease interventions, forming a diversified and high potential product portfolio. Additionally, Jenscare has been intensifying its international business expansion to enhance product influence and clinical application scale. The company's independently developed transcatheter tricuspid valve replacement (TTVR) system, Luex Valve Plus, has reached the long-term follow-up phase in its multi-center registered clinical trial in China, with excellent clinical follow-up data. The randomized controlled trial (RCT) for optimized medical treatment has successfully completed enrollment of all participants, and the application for registration with the National Medical Products Administration (NMPA) has been submitted and accepted, entering the registration review phase. Jenscare is actively advancing the NMPA registration process to secure approval as soon as possible. In Europe, the global multicenter clinical trial for Luex Valve Plus Trinity study continues to progress with long-term follow-up and registration efforts, showing outstanding clinical results. In the US, Luex Valve Plus was selected for the FDA's Total Product Lifecycle Advisory Program pilot, the early feasibility study under the FDA's investigational device exemption has completed enrollment of all participants, and the product has received reimbursement approval by devices and related costs from the Centers for Medicare and Medicaid Services. Jenscare is actively working to obtain approval for a pivotal clinical study. The transcatheter aortic valve regurgitation intervention system CanValve has received NMPA registration approval, and Jenscare has initiated its commercialization process in China. The world's hospital, the product's hospital adoption has been smooth, with active commercial implantation nationwide. Its design, operational performance, and clinical efficacy have received positive feedback. Jenscare plans to adopt a multi-tiered distribution model to rapidly penetrate the market and achieve sustainable commercial implantation, expecting to cover over 100 core hospitals in China by year-end. This is anticipated to generate significant revenue, helping the company accelerate its profitability goals. The independently developed mitral valve intervention system, Jensclip, has completed its NMPA registration application and entered the registration phase with excellent one-year follow-up results. Jensclip's globalization efforts are also underway, with pre-commercialization compassionate use surgeries conducted overseas, all progressing smoothly with strong product performance. Jenscare is preparing for Jensclip's CE certification application, and its innovation and clinical demand are expected to further strengthen the company's brand influence in China and globally. Recommendation buy at $10.40, target price $11.80, stop loss at $9.80. I do not hold the aforementioned stock.